It's been a few weeks since budget, trusts are now paying a 30% tax, and in your individual name, you're gonna be receiving what's called a non-refundable tax offset. Okay, cool, but has anyone actually explained what is meant by non-refundable? Well, in simple terms, non-refundable means if you don't pay tax, then you can't get a refund for the tax credit. And this is much worse than a refundable tax offset, where you actually do get a refund even if you haven't paid the tax to begin with. For example, franking credits on dividends received are considered refundable, and this is partly why we've seen blue chip Australian listed shares be so popular in Australia. A non-refundable offset, however, is not as good. For example, if you're earning up to $18,200, which in Australia is called the tax-free threshold, you're not actually paying a cent of tax. Therefore, if you receive a non-refundable tax offset and you're in this tax-free threshold, you don't actually get the money back for the offset. And for this reason, the changes to discretionary trusts kind of suck. Because what this means now is that if you distribute to a beneficiary up to the $18,200 threshold, then you don't actually receive a refund for the tax that you've paid in the trust. However, there are some clever things that you can do. For example, you can pay yourself a wage instead of a distribution. Check out my other video where I go into depth on how you can do this tax effectively. And just so you know, some other non-refundable tax offsets include foreign tax paid, the low income offset, the new WATO offset announced, plus many more. So